everyone, I'm Professor Boucher, and today we're going to learn how to find predetermined overhead rate and then do our cost flow journal entries for managerial accounting. Now let's get started. The predetermined overhead rate is an estimate. We're going to use that to help figure out what we are projecting our indirect costs to be for our manufacturing processes. This could be things like our factory rent, supervisor salaries, or insurance. So let's go ahead and take a look at a problem and see how we solve it. At the beginning of the year, XYZ Company estimated that they would have $500,000 in factory overhead costs for the year. Management has decided that direct labor would be an appropriate driver for factory overhead application. After reviewing records of their operations in prior years, management estimates that they will use 1,250,000 direct labor hours during the year. So during the year, 1,275,000 direct labor hours were actually used, and factory overhead costs were 505,000. First thing we're going to do is calculate the company's predetermined overhead rate. Now, whenever you work on these, if you get turned around, remember that a predetermined overhead rate is an estimate. So we're always going to want to take estimated costs over estimated driver. In this case, the problem told us that our driver is going to be direct labor hours. So I'm going to take my estimated costs. In this case, we said that our estimated costs are 500,000. And I'm going to put that over my estimated driver, which was 1,250,000. That's coming directly out of the problem. We're going to take those two, divide them. We end up with 40 cents per direct labor hour. The next step is going to be applying that predetermined factory overhead rate. We're doing this to come to a closer approximation of what the total cost to manufacture something is. That includes both our direct costs of direct materials and direct labor, as well as our indirect costs, such as factory rent, manager salary, and electricity. In this one, I am going to start with the cost. So our predetermined overhead rate is 40 cents per direct labor hour. Now, when we apply it, we no longer use the estimated driver. We're going to use the actual driver. And for us, the problem told us that the actual driver is 1,275,000. I'm going to multiply these together. That gives us $510,000 is what we're applying to work in process. So now we have to determine the balance in our factory overhead account after we have applied our predetermined overhead rate. So the problem again told us that we have 505,000 of actual costs and we have applied 510,000. We're just going to find the difference between these two, which gives us $5,000. Difference is just a positive number. The next step where we determine if it's over-applied or under-applied is lets the user know, did we overshoot or did we undershoot? So here we go. We know that the difference between the actual costs and applied costs was $5,000. Now we have to determine, are they over-applied or are they under-applied? Oftentimes my students will get a little turned around on this one. The best way to look at this is go back to your actual costs. Our actual costs are $505,000. We applied $510,000. The amount that we applied, is that over the actual or under the actual? If it's over the actual costs, we have over-applied our factory overhead costs. Now let's get started on our cost flow journal entries. This is going to be a snapshot that's going to take us through the original purchase of our raw materials all the way through the disposition of our finished goods inventory. So let's start with the purchase of some raw materials. In this case, we purchased on account $235,000. As I said, this is going to be raw materials inventory. This is for $235,000. Now the raw materials inventory, in this case, it told us is going to be on account, which means there's only two options, accounts payable or accounts receivable. In this case, I have to pay someone, so it's going to be accounts payable for that same $235,000. Materials requisitioned for use in production. All right, let's take a second on this one and talk about what requisition means. So in the production process, our production manager is going to go ahead and put in a request to our storeroom, which is where our raw materials are going to be kept, for the amount of materials they need to start their next production run. That request is called a requisition. Now remember as well, when we work on these, we have three things that go into work in process. The first being direct materials, the second being direct labor, and the third being factory overhead. Remember that factory overhead is an indirect cost. That's something that can't be directly traced to a cost object. So in this case, that $13,000, indirect costs. So the first part of the $199,000 is going to go to my work in process. This would be considered our direct materials of $186,000. The next part, since it's for indirect materials, we're going to put this to our factory overhead for the $13,000. Now, all of these materials are coming out of our storeroom, coming out of our raw materials inventory. So we're going to take this out of raw materials for the full $199,000. The next step, so the total wages that we paid during this period, $275,000. Some of that's going to be for our direct factory line workers, and other parts going to be for shop supervisor or something like that. So the part that is paid directly for the manufacturing of an item is going to be capitalized into work in process. So in this case, it's going to be the $253,000. Now my factory supervisor that we have working here, they're going to go into factory overhead for the $22,000. Now the last point, it doesn't come out in cash. The reason being is that most employees are not paid at the end of the day, or necessarily at the end of a production run. They're paid on a regular interval, every Friday, every other Friday, in which case this is going to be put into a wages payable for that $275,000. Now the next thing that we're going to talk about is depreciation. Now you guys worked with depreciation before, probably in financial accounting. And in this case, we're going to get it a little more fine-tuned. The first part of it is that we may have equipment that is used specifically for manufacturing, in which case it would be a product cost. Or it may not be used for manufacturing processes at all, in which case we would recognize this as a period cost. So let's talk about period costs and product costs for a second here. First, the product costs. What we've been working on so far are mostly product costs. This is the process of capitalizing direct labor, direct materials, and factory overhead into a work in process until they're finally finished, and then we have a finished goods inventory. That lives with us until we finally dispose of it as cost of goods sold. Whereas a period cost is something that only provides us a benefit for the period that we're in. Think of something like HR salary, right? They're helping us onboard some employees this month. That'll provide us a benefit for this month, which means we are going to expense them immediately. So the first one here is depreciation on factory equipment. I can't directly trace this to a specific product cost, so I'm going to put this into my factory overhead for that $15,000. Then, where is it going to come from? My credit. Some things don't change. It is still going to go to accumulated depreciation. I'm just going to let everyone know that this is for factory equipment for that $15,000. All right, I'm going to make a change on the fly on this one. I don't like that it's $15,000 because it may get us confused later on. So I'm going to change my depreciation on office equipment to $25,000. Depreciation of office equipment. Maybe this is a copier that's used by the accounting department, in which case it does not provide a direct benefit to manufacturing. We're going to expense this in the period it occurred, so you guys are used to depreciation expense for that $25,000. And then it's still going to go into an accumulated depreciation account, but now I'm going to let everybody know that it is for office equipment, still for that $25,000. Previously, we learned about predetermined overhead rate. Now we have to figure it out again for this problem. So our estimated factory overhead cost for the period was $98,000, and estimated direct labor hours for the period were 49,000 hours. Assuming that overhead is applied based on direct labor hours, and the company used 45,000 direct labor hours during the period, apply that factory overhead. So first, I'm going to come up with the predetermined factory overhead rate. Remember that it is going to be estimated costs, which in our case are going to be $98,000, divided by our estimated driver, which in our case is again going to be direct labor hours, but now it's going to be 49,000 direct labor hours. This is going to go ahead and give us a cost of $2 per direct labor hour. Now we have to apply it. So remember, when you're applying it, you're going to take your predetermined overhead rate multiplied by your actual driver used. So in our case, we know that our predetermined overhead rate is $2 multiplied by our actual direct labor hours used, which in this case are 45,000. So we are going to have $90,000 that we are going to apply to work in process. So let's go ahead and do that. We are going to debit work in process for the $90,000. And then we're going to take it out of factory overhead for the $90,000. Now, I like to call factory overhead a bucket account. Why? Because we just use it to accumulate things. We take all sorts of costs that we don't directly apply to a product, and we just dump them into this factory overhead bucket. And then when we finally get to the end of the process, we're going to go ahead and take these costs and apply them to our overall product. So we're dumping out the bucket. So, bucket costs. Now we know what just came out of this bucket. We dumped it out and we took $90,000 out of this bucket. Now, that's mostly an estimated process. So the final thing that we're going to do when we come to the end of the period is we're going to close out factory overhead. We need to make sure that at the end of this period, this bucket is completely empty. So now let's go ahead and see how much did we put into this factory overhead bucket. We're going to go back to the journal entries we already did. And each time that we debited factory overhead for things like materials, labor, and depreciation, we're going to go ahead and recognize that in the T account. In which case we had $13,000 for materials, we had $22,000 for labor, and we had $15,000 for depreciation. All of those went in as debits. Now we're going to go back and see, did we go ahead and credit factory overhead? And we did when we applied it to work in process. We had a credit to factory overhead of $90,000. Now what we're going to do is we're going to go ahead and see what is the remaining balance in factory overhead. To do this, I remember that my debits and my credits offset each other, and we're going to see what our final balance is. Already looking at it, we kind of know that we're going to end up with a credit balance over here, and that credit balance is going to be for $40,000. As I said before, we need to take this account and bring it to zero. So $40,000 is the amount that I have left in my factory overhead account. I need to bring this account to zero. So to bring it to zero, I'm going to have to do a debit to factory overhead of $40,000. That's going to bring our account to a zero balance here. The reason I like using T accounts, I just figured out that I have to do a debit here of $40,000 to factory overhead. Now I know exactly that journal entry I need to start with. I need to do a debit to factory overhead for that $40,000. And it told us to close it to cost of goods sold. So we're going to credit this to cost of goods sold for that $40,000. As you move on, you're going to have to use these T accounts. For instance, when you get to a quiz in this class, you need to use the T account. If you don't use the T account to show your work, you are going to lose a substantial amount of credit. The last two steps here, you guys can probably do these without me, but let's go over them anyways to finish up our process. So the jobs completed during the period were 525,000. Remember, work in process is where we put items when they have not yet been fully completed. But once they're fully completed, they're going to make their way into our finished goods inventory for that $525,000. And I just said they're coming out of work in process, so we're going to recognize a credit to work in process for that $525,000. And finally, we are going to sell these items. We said that they first come in as raw materials. We capitalize them as work in process until they are finally disposed through cost of goods sold. So we're going to sell the rest of these products as a debit to cost of goods sold for our $433,000. And they are coming out of our finished goods inventory for that $433,000. Now we're going to take a look at J. J is a little more of a problem, seeing if we understand how these processes are working. So we have a missing number that we would normally be given. How do we back our way into it? We're starting with estimated factory overhead cost for the period was $75,000, and estimated direct labor hours for the period were unknown. Assuming the overhead is applied based on direct labor hours, that the company used 16,000 direct labor hours during the period, and total factory overhead applied was $80,000. What is the total amount of estimated direct labor hours for the period? And on this one, it didn't give us our estimated driver, but what they did give us was the amount of overhead applied. What we're going to have to do here is first, we have to come up with what was the predetermined overhead rate. And the way that we figure that out is we take the overhead that was applied, which is the $80,000, and we're going to divide that by the 16,000 of direct labor hours actually used. That's going to give us $5. Now that we figured out our predetermined overhead rate, we're going to divide that into our $75,000 of estimated costs to come up with our estimated hours. So we had $75,000 of estimated costs divided by our $5, which is our predetermined overhead rate, and that's going to give us 15,000. Now remember, this is not dollars, that is our estimated driver, in our case, direct labor hours. Now a few things to remember. First, when you're working with predetermined overhead rates, you will always take estimated cost over estimated driver, and then you apply it using actual driver. In this problem, and in the problem before, we saw that was all going to be direct labor hours. It doesn't always have to be direct labor hours, so keep an eye on that. The other thing that we learned in this class was how to go ahead and close out the factory overhead account. Make sure to pay special attention to that, because as we saw in the first problem, factory overhead can be under-applied or over-applied, and that T account will help us figure it out. I hope this video was helpful to everyone, and we will see you in the next one.